Everyone can name intuitive surgical. Almost no one can name the second best way to own surgical robotics. And that's not because the tail is empty. It's because the whole sector gets mapped the wrong way. The real map isn't body parts. It's who owns the rent. This is a sector overview built on that idea. Start with what everyone knows. Intuitive Surgical, maker of the Da Vinci robot, is roughly 60 to 70% of the market, and around 86% of its revenue is recurring. $10 billion a year, 11,000 systems installed. It is an annuity wearing a hardware costume. Then there's everything else. 30-plus challengers across 8 different modalities, almost always sorted by body part. That tells you how big each segment is. It does not tell you who wins. Mismapped and therefore mispriced. Why look now? 3 things just changed. 1. The tail re-rated. Stereotaxis, a small company, just won FDA approval for its own ablation catheter, adding a consumable annuity it never had. The so-called dead tail is not dead. 2. Telesurgery shipped. The first FDA-cleared transcontinental robotic surgery ran from Florida to Angola, and SS Innovations is now cleared for remote surgery across India, Indonesia, and the Philippines. 3. China crossed over. In 2025 hospital tenders, domestic robots took about half the awarded volume. The tail is starting to compound. So here's the move. There are 2 ways to cut this market. The standard cut is by anatomy, soft tissue, orthopedics, spine, neuro, bronchoscopy, and so on. That answers how big each body part segment is. It tells you size, not who keeps the money. Our cut is different, how the robot acts, crossed with where the rent goes. That answers the only question an investor cares about, who structurally captures durable revenue. Same companies, different sort. The second sort is the whole video. First axis, modality. How does the robot actually act? There are 8 ways. Rigid multiport arms like Da Vinci, Hugo, and Ottava. Single-port systems through 1 incision. Magnetic navigation for heart ablation where Stereotaxis lives. Flexible scopes that go through natural openings like Ion and Monarch. Catheter and endovascular robots. Energy delivery like focused ultrasound and radiosurgery. Orthopedic haptic arms like Mako. And handheld cobots. 8 ways to move an instrument. Here's the key point. None of them by itself is the moat. Second axis, and this is the important one, the moat. Where does the rent actually go? 6 archetypes. The strongest is Consumable-annuity, the razor and blades model where metered instruments lock in recurring revenue. Then implant pull-through where the robot exists to sell the implant. Disposable scope where a single-use scope is itself the consumable. Telesurgery networks. Software and AI overlays still unproven. And at the bottom, the trap, capital equipment only, where you just sell the box. Remember, the single largest revenue segment in this whole market is instruments and accessories. The box is the loss leader. The blade is the business. Put the 2 axes together and you get the map. Modality down the side, mode across the top. Now the picture changes. The green column, Consumable-annuity, is the prize, and look who sits in it. Intuitive in rigid and single port, focal thorax in energy delivery, and Stereotaxis in magnetic navigation, marked new. The orthopedic players cluster under implant pull-through, and the trap column collects the capital equipment names. 1 asterisk. SS Innovations is building a telesurgery network instead, and we'll come back to it. Here's why this resort matters so much. Anatomy tells you the size of the pool. Urology is an X billion-dollar robotic segment, and so on. Moat tells you who keeps the money inside that pool. And here's the trap the standard map hides. The same anatomy segment can contain both an annuity compounder and a capital destruction story. Sorting by body part blends them together. Sorting by moat pulls them apart. And that's what surfaces both the real opportunity and the real trap. A quick word on size, because one number tells the whole story. The market is roughly $14 billion in 2025, heading to somewhere between 27 and 40 billion by the early 2030s, growing in the mid-teens. The figures vary because scope varies. Orthopedic numbers often count implants, not robots, but the headline isn't the point. The largest single segment is instruments and accessories. The biggest slice of surgical robotics revenue is not robots. It's the disposables robots consume. Own the consumable, own the sector. So let's walk the moat, starting with the prize, consumable-annuity. The benchmark is intuitive, around 86% recurring revenue, wristed endo-wrist instruments with a usage lockout chip, proprietary fiber optic shape sensing, single source, and roughly 11,000 installed systems, every one a captive consumable base. Why is it so hard to displace? The robot is seated near cost, and every procedure burns metered instruments. To dislodge it, you'd have to retrain surgeons and revalidate consumables at the same time. This is the moat everyone else is trying to manufacture. And one company just did. This is the re-rating, and it's the sharpest update in the sector. Stereotaxis, a company worth under $200 million, just switched on a razor and blades engine. Its MAGC ablation catheter is FDA approved. Its Genesis X robot and Synchrony platform are both cleared. Until now it depended on Johnson & Johnson's catheters, which meant it couldn't capture the disposable revenue. With its own consumable, that changes. The old read was a $32 million niche with no annuity. The point is the annuity was structurally absent, and MAGC supplies exactly it. A system-only company is becoming a consumable company. It's the clearest public example of a tail name crossing into the prize moat. Second moat, implant pull-through. This is the orthopedic and spine world. Stryker with Mako, the number 2 player overall and the leader in orthopedics. Globus with Excelsius, spanning spine and brain on 1,000+ patents. Zimmer with ROSA, and Johnson & Johnson with Velis. Here the robot is placed near cost and it pulls through the implant, which is where the real margin lies. So you don't buy these names for the robot. You buy the implant flywheel. Robotics is the feature, not the franchise. Now 2 moats that the robot-only market sizing completely misses. First, disposable scope. Huge med sells single-use ureteroscopes and is pushing hard into emerging markets. Quanta sells laser systems for stones and enlarged prostates. The scope itself is the consumable, and the volume scales where cost matters most. Second, the telesurgery network. SS Innovations is cleared for remote surgery in India, Indonesia, and the Philippines, with over 150 remote procedures and an install base in 10 countries. Its moat isn't the box, it's the network. Both of these live outside the standard market map, which is exactly why they are undercounted. And then the trap, capital equipment only. You sell the box, revenue is lumpy, and there's no annuity underneath. The clearest example is robotic endovascular surgery outside of heart ablation, which has been a capital graveyard for a decade. Siemens wrote off around $360 million on its core path system, and player after player has exited. The tell is always the same, a beautiful market forecast with no consumable, no reimbursement path, and a single modality, same surgical robotics label, opposite economics. So where does the rent actually go? Ranked by moat durability. Intuitive first, the benchmark compounder. Stereotaxis second, the re-rating and the one to watch for its first real recurring revenue quarter. The orthopedic incumbents third, durable but owned through implants. Focal thorax fourth, a focused pure play. The private disposable scope names fifth. SS Innovations sixth, network optionality on razor economics. And dead last, endovascular outside ablation to be avoided. The takeaway, outside intuitive, the cleanest public way to own this moat is the name the old map dismisses as a niche, Stereotaxis. Here's what live signal adds that a static report can't. We track over 800 accounts in this space, and 4 things light up. Telesurgery moved from concept to FDA-cleared reality. Single-port surgery is spreading through a global surgeon community, with new platforms appearing in China. China's substitution shows up as a value versus volume split, and focal thorax completed its pivot to pure-play robotic-focused ultrasound. Every one of these was cross-checked, against independent sources. A closer look at China, because it's the most misread part of the story. In 2025 tenders, domestic systems took about 52% of awarded volume, but Da Vinci still led on both units and value. So it's a value versus volume split. Domestic wins the unit count, the incumbent keeps the dollars. Microport's Taomai has over 200 orders and 400 remote surgeries. This creates two risks: low-price substitution in emerging markets where intuitive is thin, and single-port cloning, which attacks the exact modality intuitive used to deepen its moat. What about the supply chain? It's a shared body with a unique soul. The shared commodity parts are the same as any robot: precision motors, harmonic drive gears, rare earth magnets mostly from China, NVIDIA compute, sterilization capacity. But the defensible parts are unique: single-source fiber optic shape sensing, wristed metered instruments with lockout, validated software, FDA clearances, and a clinical evidence base. Margin accrues to whoever owns the regulatory validated consumable, not the component vendors and not the hardware, which is seated near cost. And this is the structural reason surgical robotics doesn't commoditize the way humanoid robots will. A supplier is part of the regulatory filing, so a cheaper component swap reincurs months of work and a $1 to $5 million approval, which means cost down is blocked, and the consumable annuity is structurally protected. That's the real answer to won't China just undercut everyone. The regulatory overlay is the moat that humanoid robotics simply does not have. Now the honest part. What breaks this thesis? Telesurgery reimbursement, because there's still no US payment pathway, and that gates the whole network moat. Single-port cloning out of China. Execution at Stereotaxis, where MAGC has to actually convert into recurring revenue. China moving from volume share to value share. And the perennial trap, any name with a big market slide and no consumable. The sector without the moat is endovascular outside ablation. The pattern that breaks the rule is the warning label. So how do you actually own this? 3 shapes. Pure plays, where robotics is the actual driver. Intuitive, Stereotaxis, Globus, Accurate, Focal Thorax, Microbot. Incumbents, where robotics is a feature on an implant flywheel. Stryker, Medtronic, Johnson & Johnson, Zimmer, Smith & Nephew. And the ex-US basket, Microport, SS Innovations, Tinevi. And the 4 things to watch. The first recurring quarter at Stereotaxis. Telesurgery reimbursement. China's substitution speed and single-port cloning. So here's the one line to take away. Own the rent mechanism, not the anatomy. The market is one consumable annuity monopoly plus a long tail, and that tail is almost always sorted by body part, which hides who actually keeps the money. Sort it by moat instead, and the prize column comes into focus, along with one genuine re-rating. This is cortical flow research opinion, not investment advice, cross-checked against 20 independent sources. Do your own diligence, and thanks for watching.